Hello, and welcome to the Margin of Sanity podcast. Today, I want to take a look under the hood, so to speak, on my actual investment portfolio, so you can get a little more insight into what I actually own, when I bought it, and more importantly, why I bought it, as well as my general thoughts on the positions going forward. If you're listening on a podcast player like Spotify or Apple Podcasts, and you want to go back and read through any of this, the entire write-up is available totally free on the Margin of Sanity Substack. And to the 4 people following the show on Spotify, I just want to say that I see you, and I appreciate you hitting that follow button. It's pretty cool to see that anyone's listening at all, so I'm going to keep doing this because I'm having fun. All right, let's get into it. One of my pet peeves is when I see individuals title a post or podcast or video such and such revealed. It always feels like kind of clickbait and it irks me. Plus, who the hell are you that I care what you're revealing? The people whose portfolios I actually keep an eye on are legally required to reveal themselves every quarter in a 13F filing with the US government. Still, I think if I'm planning to continue with this Substack, which I am, I should try and be as transparent as possible with you. I will make mistakes, and if I've done my job, then you will know about those mistakes and, more importantly, why I made them. The entire reason I started this Substack in the first place is because I was already pretty much writing it to myself in my Notes app to track my own decision-making. At year-end, actually, I write myself a letter to shareholders, which includes all the good choices, bad choices, and the reasons behind them. I'll admit there is a temptation to lie here and shine the best possible light on myself. It is fun to get subscribers and likes and all that stuff, but I'm absolutely sure that if I go down the road of misrepresentation, I will almost certainly end up with subpar investment results, and I would deserve it too. The irony would be too much to bear, so I will stick with the truth, which leads me to my very lame and embarrassing confession of my largest 2 positions. 25% of my portfolio is QQQM, which is the NASDAQ ETF, and another 13% is SPY. Yes, I own the indexes, but before you judge me, I just need to make something very clear. My portfolio consists of all of my money. I always wonder about some of these investors I've seen post portfolios that would pretty much keep me up at night, until I realize there's a pretty solid chance that that isn't actually where they have the bulk of their net worth. It makes for better content, but frankly, I care more about my returns than the popularity of my Substack. Moreover, there were times in the past when the market was cheap, and I had cash and no time because I do have a job, so I bought the damn indexes, and I'm glad I did. They're solid investments, and more importantly, they're a hedge against my greatest risk exposure, myself. I'm not someone who conflates risk with volatility, a great topic for another write-up. I don't care if my net worth swings up and down so long as I have faith in what I actually own. The risk I'm actually exposed to is really me, being cocky, underinformed, or even worse, partially informed. But fear not, I'm in this game to win it. And over the last 2 to 3 years, virtually all of my new capital has gone into individual positions. The remaining 62% of my net worth is invested in me and my ideas. As I've gained experience as an investor, I've also gotten more comfortable having the bulk of my assets in individual companies. Okay, enough of me being defensive. Here is a breakdown of each position with a brief explanation of why I own it, when I bought it, and what I'm looking at down the road. Now to the positions themselves, from smallest to largest. At 2%, Microsoft, ticker symbol MSFT. I bought Microsoft in early 2022 simply because of valuation. It wasn't a very well thought out idea, to be honest, but it seemed like a no-brainer. Plus, I've doubled my money, so I'm not super upset about it. At the time, I had little cash and I didn't want to buy an index, so MSFT seemed like an easy choice. Microsoft traded at a pretty reasonable, if not cheap, valuation for such an incredible company, with a fast-growing top and bottom line, despite its size. They have a rock-solid balance sheet, strong earnings, free cash flow, and management has been buying back shares for a long, long time. Azure is also growing quickly as the world's businesses are moving to the cloud. Integration of OpenAI's technology into the cloud seems rather frictionless, and I'd imagine Microsoft has an advantage over other companies trying to make this transition simply because their software is already embedded into the US economy and trusted by thousands of businesses. But is that an awesome reason to own it now that the earnings multiple has risen from 25 when I bought it to 35 today? Not really. I'll probably sell this one pretty soon, as I've found many other companies I'd rather own since I initially took that position. Speaking of, tied with Microsoft at 2%, we have OTC Markets Group, ticker symbol OTCM. And you thought I was just going to buy boring old big tech. Ye of little faith. OTC Markets Group is a fascinating business. It's a smallish company, about a $600 million market cap, but it plays an important role in the economy. If you've been on Substack for a while, you've likely seen a lot of people mention nano-cap or micro-cap companies. These small companies can't yet afford access to large stock exchanges like NYSE or NASDAQ, but they still need access to liquidity. Enter OTCM. These guys are not a regulated exchange, but they function like one. They also enable foreign companies that are listed on foreign exchanges to access the deep pockets of US investors. Moreover, for a lot of large or mid-sized international companies, OTCM is a great way to make their stock available to US investors without needing to comply with or pay for NYSE or NASDAQ. The companies listed on OTC markets pay an annual subscription for that privilege. OTCM also then charges market makers a subscription for the right to trade those securities, as well as a per-transaction fee. Finally, OTCM charges companies like Yahoo Finance or Bloomberg for the data, i.e. stock quotes and financial information. OTCM has a crazy high margin, very high ROE, and regularly returns cash to shareholders via dividends. It trades at about 20 times trailing 12 months PE with a rock-solid balance sheet, but it has had some lackluster growth in the wake of the cool-off from the 2021 meme stock trading frenzy. The natural monopoly of this business is what appeals to me, as does the incredible economics that come with it. I've only just started buying OTCM, and my only hesitation in buying a lot of it is the uncertainty around growth. It seems to me that there isn't very much OTCM can actually do to actively grow its network. That said, there are definitely things they are trying, and I'll cover all of it in a future deep dive. Next up, Apple, ticker symbol AAPL, position size 2.5%. Okay, maybe I do own some big tech. But while I was buying Microsoft, I was also buying Apple. It's a company I felt I understood better and also liked more. After doubling my money yet again, I also sold half my Apple position recently when the price went above $250 a share around the new year. The multiple had gotten far too pricey for me, and frankly, I've had some concerns about Apple as a business. While I absolutely adore the cult-like loyalty of the average Apple user, I'm not sure it's enough to make up for the high multiple, flat revenue, regulator-forced weakening of the App Store moat, potential loss of the $20 billion a year Google pays them, unprofitability of Apple TV Plus, lack of demand for the Vision Pro, and just general sluggishness of the business. Frankly, I also sort of think that while Apple has a lot of pricing power, there is a limit to what people will pay. Moreover, Apple has been slow to offer any impressive AI integration into Siri, leaving the door open for a company like Google to sell their Pixel phones, of which I am a proud owner, as the AI phone. If they could undercut Apple on price and utility, Google could start taking some market share in phone sales. I think I may have caught the tail end of the Apple is a magical company narrative. If people don't upgrade their phones constantly, regulation weakens the App Store margins, and Apple can't get the bottom line to grow, then I can't imagine how buybacks alone will be enough to justify today's multiple. I still own some, but this one is on the chopping block, unless I can find a reason it is still as good as some of my other ideas. Next up is the shortest one. This is Berkshire Hathaway, ticker symbol BRK.B. It's a 3% position. This is the first stock I ever bought, and I'll pretty much never sell it. It's beating the market, and I love owning Berkshire. Plus, I'm really not smart enough to value it properly. Okay, next up, the Coal Bet. Alpha Metallurgical Resources, ticker symbol AMR, plus Warrior Met Coal, ticker symbol HCC, together equaling about 3%. My coal bet write-up has been very popular, and it's free, so go check that out if you want the full rundown. I started buying up coal producers early this year as a way to shift my portfolio out of the way of big tech. If you haven't guessed where the other half of my Apple position went, this is part of it. Coal companies have been thrown in the trash thanks to a cool-off in China, regulations around lending to coal miners, and frankly, institutions just not wanting to advertise a portfolio with coal in the mix. But not all coal is created equal, and the coal bet is all about steelmaking coal, not thermal coal for power plants. For a myriad of reasons which I've outlined in my original write-up, hint hint, go read that if you haven't, I expect global demand for steelmaking coal to rise over the next decade, and these two companies are my favorite way to position for it. Next up, Celsius Holdings, ticker symbol CELH. This is a 3.5% position. I bought Celsius pretty much the day after I realized it was publicly traded. For those who don't know, Celsius sells sugar-free, better-for-you energy drinks to both men and women. I had been drinking these things daily and foolishly never bothered to see if I could invest in it. The interesting thing about Celsius is that they are not only in third place behind Red Bull and Monster in the energy category, but their customers consist of a lot of people who previously weren't energy drink people, women in particular. The way I saw it, these guys found a way into an incredibly lucrative and fast-growing market without having to go head-to-head with any of the big players. It's hard for Monster or Red Bull to reinvent themselves after 2 decades of establishing their brand identity as something akin to jet fuel for badasses. Moreover, I love the product, and I found a way to rationalize buying it at $41 a share. Before the stock rallied above $90 a share, back down to $50 where I bought more, back up to $90, and then crashed down to the $20s where I bought more again. Currently, I'm flat on this position, and it's been a brutal journey. The reason behind their tanking share price has to do with the way that Celsius books their revenue from their largest distributor, Pepsi. The long and short is that Pepsi instituted some inventory optimization last year, which basically just means that they were buying too much Celsius too quickly. This sent 2 big signals to the market. 1, some of Celsius's eye-watering growth was BS. And 2, Celsius was about to have a few bad quarters. By now, a lot of that pain is in the rearview mirror as Celsius has recently announced the acquisition of their biggest direct competitor, Alani Nu, an entirely female-focused energy drink maker. Before the acquisition, Celsius had a beautiful balance sheet, no debt, and plenty of cash, and now it's less beautiful. I also don't really love management's use of pro forma non-GAAP adjusted EBITDA in the acquisition announcement. It sends the hair on my neck up when I hear such jargon. I also basically don't like the idea of buying growth, even if there is synergy, another term I dislike. I'm swaying back and forth on this one. I love the product and the market. I know a lot of folks who drink this stuff daily, myself included. Moreover, Celsius is trying to expand into international markets, albeit not as fast as I initially hoped. I think ultimately it could be a wonderful company, but I question the moat as well as the management. Caffeine is habit-forming, and Celsius has enough flavors that you'll eventually find one you like. Year to date, Celsius has actually been my best performing position with a return of 47%. All right, next up, Netflix, ticker symbol NFLX, 4% position. I covered Netflix in my second ever write-up when I laid out the way that the company's content library is amortized, and how this masks a lot of Netflix's real value. But that's why I hold it, not why I bought it. I purchased shares of Netflix seemingly moments before the sell-off in late 2021. It wasn't the best time to buy, but incredibly, I'm still up almost 100% on those initial shares, and even more on the ones I bought subsequently. It's really just as simple as this. Netflix is not a discretionary purchase. See, maybe you're like many people who use their parents' Netflix, or you have your own personal account. But now imagine you're the parent, and your child or spouse watches Netflix, but you don't. Now imagine the conversation where you tell them you're canceling Netflix. I now pay for both my mom's and my Netflix, and she's hooked. there's no way I could cancel it now. Fortunately, unlike Hulu, which I can't stand paying for, I feel I get a good value for my Netflix subscription. Since I bought the stock, the ad tier has been an impressive growth driver. They've also expanded into live events and sports. Netflix's drive to survive is an excellent example of Netflix leading culture, as 1 in every 4 F1 fans say they became a fan after watching the Netflix show. Moreover, Netflix's decision to withstand cultural pressures on some of their stand-up content was, in my opinion anyway, pretty forward-looking, since culture does swing back and forth and change over time. Netflix has won, and that's pretty much all there is to it. Sure, there are times I can't find anything good to watch, but I really never think about canceling the subscription because of that. I think Netflix has many years ahead of it, entertaining not only the US, but the entire world. Toss on a VPN and see how many shows, how many languages, and in how many countries Netflix actually offers content. It's a wonderful place for quality entertainment, and I don't see any shift away from Netflix in the future. The valuation is a bit frosty, but as I explained in my amortization write-up, there is more value hidden in its content library. Moreover, they have a lot of pricing power as more and more households cut the cord of cable and move to streaming. Netflix's valuation would have to get to an absurd level for me to sell it. Alright, we're moving to some core positions here. Eagle Materials, ticker symbol EXP, at 7%. Concrete? This guy owns Netflix, Celsius, and Concrete. Yep, you may even say I believe in Concrete more than I believe in Netflix. Eagle Materials is also a newer position of mine and one I was buying aggressively alongside coal. I bought some in early 2025 and continued buying as the market fell to lower my cost basis. Why concrete? Well, because it's so damn cheap and so damn heavy. Once you transport concrete over 300 miles by road, you may as well have not sold it because the cost per ton is unlike any other product I know of. It's just too heavy and literally not worth the cost to ship it long distances. The unit costs of concrete make it a highly localized business, and one where you don't have to compete with cheap foreign products. Even within states and counties, concrete producers are local monopolies. Eagle Materials has spent 2 decades buying up assets around fast-growing geographies in the US in order to both corner the market and also vertically integrate their business, thereby making them the lowest cost producer in every area in which they operate. They make concrete for industrial use as well as gypsum wallboard, sheetrock. At a 16 or 17 PE, a 30% ROE, and a 20% net margin, these guys are killing the concrete game. The balance sheet checks out with plenty of cash and debt equal to less than 3 years of net income. The numbers all look good, and management buys back shares whenever the stock slides. I love buybacks for value ideas, so I was very happy to see management agrees. Moreover, when times get tough and other suppliers go underwater, Eagle is able to buy them up and continue to cement their place as the go-to supplier for builders. Side note, I have a write-up coming for EXP, so stay tuned for that. The next position is 8%, and I can't tell you what it is because it's a $30 million company with a highly illiquid stock, and frankly, I may just not be done buying yet. Plus, the company is buying back their own shares, and I'd rather not do anything to alert the world to its existence just yet. Perhaps I'll do a write-up for paid subscribers, but I'm still not sure. Shoot me a message on Substack if that's something you'd be interested in. Alright, next up, Amazon, ticker symbol AMZN, 9%. Amazon, alongside that mystery company from earlier, is a core position of mine. I purchased shares in Amazon around the same time I bought Netflix in early 2022. I bought some more in the August 2024 dip and really ramped it up to a core position during the tariff sell-off. Amazon is a beautiful company, with its hands in many pies. Of course, they are most famous for their e-commerce platform and lightning-fast delivery service, but that business alone is really not impressive economically, at least not the way one would guess. Amazon doesn't buy for a nickel and sell for a dime. Instead, they get paid by third-party sellers on their platform who rely on Amazon's seller services to facilitate their own businesses. Amazon has built a moat of CapEx around their vast seller services and delivery business, such that it makes no sense for competitors to enter the ring. It's a toll road on e-commerce, and Amazon has done a wonderful job of leveraging that position. They squeeze sellers and provide customers incredible price, service, variety, and speed. Everything you would want as a consumer. But even that moat of CapEx wasn't enough to enthrall me. What really blew my mind was when Amazon flipped a switch and manifested a world-class advertising business seemingly overnight. Imagine the buying data possessed by Amazon. And now imagine you want to advertise your product to potential customers. Who on this planet has better buying data than Amazon? Meta? Nonsense. Amazon is where people go to buy stuff, and Amazon knows what you buy when you buy it, and probably even how you feel when you bought it. Plus, the Fulfillment by Amazon product suite is such a vital tool for sellers that it's almost mandatory. They handle inventory, payments, and shipping in such a way that it really doesn't make sense for sellers to try and do it themselves. You must pay Amazon for the right to advertise your widget, list your widget on the site, and ship it from A to B. Maybe you bought for a nickel and sold for a dime, but Amazon charged you 40 cents for that privilege. But hey, it's not a monopoly. Anyone who wants next day or same day delivery can just go ahead and spend the many, many billions of dollars that Amazon spent building out that infrastructure. Love it or hate it, Amazon is not smoke and mirrors. It's genuinely an engine of economic efficiency. That engine may be in fourth gear in the US, but it's still shifting into first and second gear in much of the world. Amazon still loses money with this business in other countries as it gets the world hooked on its convenience and low prices. I live abroad, and the local delivery here in Southern Europe is abominable compared to Amazon. Eventually, those international segments will turn a profit as they do in the States, but Amazon is in no rush as they continue to build out a global delivery network that makes DHL look like the Pony Express. Did I miss anything? Oh right, AWS. To explain AWS, I'd like to tell the story of how Bezos actually came up with the idea. He was on a tour of an old factory from the early 20th century when the tour guide pointed out an old power generator that, once upon a time, provided that factory with its electricity. Bezos realized that every company used to have its own power generator that it used to electrify the building and its operations. Today, of course, that power is purchased from the grid. The system of independent power generation is incredibly inefficient compared to the grid system we have today for a whole host of reasons. Anyway, while Bezos was on this tour, it occurred to him that the businesses of the world today were all operating their own servers. The light bulb went off, and Bezos realized in that moment that such a system for compute was also very inefficient. What if one company offered compute power as a utility and rented that compute power to businesses as a service? And so Amazon Web Services was born. If Amazon's e-commerce business seems like an octopus with tentacles in and around the economy, then AWS is the water itself. Today, 2.38 million businesses run on AWS. I love owning an asset where, if it disappeared overnight, there would be a national security emergency. That's a sign of a moat right there. The margins on AWS are as lovely as its growth, and as it stands, AWS's growth is constrained by supply, not demand. And what, pray tell, is constraining them? Taiwan Semiconductor Manufacturing Company, ticker symbol TSM, 9%. As Amazon, Microsoft, Tesla, Google, and Meta all pour capital into the expansion of their cloud businesses, the thing they're all spending hundreds of billions of dollars on is the dang chips. The CPUs and GPUs needed to run massive data centers are designed by a variety of different companies, the most famous of which is NVIDIA. But NVIDIA doesn't actually manufacture their chips, neither does AMD, Apple, or Qualcomm. Instead, these chips are made by basically one company who has left every other chip manufacturer in the dust, TSMC. I bought my initial position in TSM in 2020 for around $50 a share. Today it sells for $194 a share, and I've barely added to it until recently. On its own, TSM has grown to one of my largest positions, and it's easily my oldest single position besides Berkshire. Since my initial purchase, TSMC has rapidly expanded its capacity for chip making in the US, as the demand for HPC, high-performance compute, has exploded thanks to AI. All those NVIDIA chips the world is crazy for, made by TSM. Your new MacBook? The CPU was made in Taiwan. Even your car probably relies on Taiwanese chip making to unlock the damn door. There isn't really a company on Earth as important to global growth as TSMC. And after I read the book Chip War, I was essentially convinced of that fact. I should do a deep dive on TSM because there is a lot to talk about, but I finally added to this position during the tariff sell-off. Over the last 5 years, I've watched TSM make an absolute cuckold of Intel. Unlike TSM, Intel both designs and manufactures its chips. The problem is, they just don't do either thing very well. It's gotten to the point where recently Intel has basically contracted TSMC to actually manufacture their chips. For a company that has spent hundreds of billions on chip fabs, this is embarrassing. I don't expect TSM to lose its position at the top of the heap anytime soon. TSM is basically a pick and shovel play on all technology, and they don't even trade at a pricey valuation thanks to fears about a potential Chinese invasion of Taiwan, something I'll cover in the deep dive. You don't have to know how AI is going to play out to realize that TSMC will play a leading role in that story. And finally, my last position, Visa, ticker symbol V, 9%, tied for largest position with TSM and Amazon. I love Visa for its simplicity, insane margins, incredible ROE, and its natural monopoly that enables it to float above the muck of competition. I've never intended to make this position so large. It's more that I've steadily added to it since 2020 anytime the PE had fallen below 30 or so. It's grown all the while, and so it's found its place at the top of my portfolio. Visa, along with MasterCard, enables instant electronic payments across its network. Customers, businesses, and banks all create a global payment network run on the high-speed rails of Visa. I love it because it's so darn quiet. 639 million transactions are made on Visa's network per day. They're performed instantly, safely, and easily, and you probably never even think about it. But each time you swipe that card, Visa takes a cut, and so do I. Moreover, Visa and MasterCard make up a powerful duopoly, and they do so without having to violate the Sherman Antitrust Act. They're what's referred to as a natural monopoly. Think about it like this. It's hard to convince someone to use a credit card that isn't accepted by businesses, and it's hard to convince businesses to accept a credit card that nobody has. That's not illegal, it's just lucky. And so Visa and MasterCard dominate this extremely capital-light business. In the words of MasterCard's CEO, they don't compete with each other, they compete with cash. And as these two giants grow, they do so with very little capex and plenty of capital returns to shareholders in the form of both buybacks and dividends. Besides possibly Berkshire, Visa worries me the least of any position I own. They just move along at a steady clip, earning incredible returns on capital and returning what's left back to me. The choice of Visa versus MasterCard is something we can debate, but really both are fantastic businesses with incredibly dominant positions and extraordinary fundamentals. Parting thoughts. This portfolio looked very different a few months ago. As we entered 2025, I was heavily invested in a few REITs as well as Ulta Beauty. Both of those positions held up really well in the tariff sell-off as investors fled to safer assets and Ulta beat on their earnings. I sold all of it and flooded the proceeds into my core positions, as well as some newer ideas like coal and cement. I'm working my way toward a more concentrated portfolio, and so it's rather likely I will end up exiting a few other positions given the right price. Apple, for example, is inching closer and closer to a valuation that seems rather rich. So if it were to return to a 40 PE without any real cause, I would likely sell the rest of it. Hey, I may even just sell it today if the mood hits. Celsius has been a test of my claims that I don't care about volatility. I make claims and Mr. Market laughs. Still, I love the product and the business, so I'm tempted to see it through at least one more year. That said, if I need capital for another idea, my Celsius position may be a good place to find it. I just really prefer the straight-shooting management style of Eagle Materials. In a future write-up, I'll dive deeper into some of these positions and maybe even write a bit about how my investment style has evolved since I began investing in 2019. I hope this was useful to you, and I'll be back soon with another deep dive. There it is, my portfolio revealed. I feel so naked now.